Welcome to Chapter 8. Needless to say, it's one of my favorite chapters. I think I can say that about just about all of them.
I was going to say, don't you say that every week?
Yeah, pretty much. Yeah. Trying to hit the slideshow thing. There it goes, finally. Yeah. The nice thing about capital budgeting, or I should say that the nice thing about this chapter on capital budgeting is that it presents a lot of real world, real life situations that you might actually use on the job. Now, like if you only have 500 million to invest, where's the best place to invest it? We all run into that problem, right?
Oh yeah.
Yeah. Billions of dollars worth of opportunities out there, but if you only have 500 million to play with, where do you put it? Of course, they leave out a lot of things like risky investments. You can make more from risky investments than you can from safe investments, but you can also lose a lot more. And they don't mention any of that stuff because that's what they call a complicating factor. But that's okay. We can deal with that. So some typical decisions you might make in the real world: plant expansion. How much is it going to cost to expand the plant versus how much additional revenue you can generate if you do expand? Equipment selection. Should we buy a new piece of equipment that'll save us $5,000 a month, or should we stay with the one we have and just recondition it for $2,000? Or we have two pieces of equipment. Which one should we buy? We only need one of them. Which one would be better? Or equipment replacement, and should we keep what we have or should we buy a new one? Lease versus buy. Should we buy something or should we lease it? Do they talk about the tax aspects of leasing versus buying in this chapter? Anyone want to venture an answer on that? Do they discuss tax aspects of lease versus buy?
Yes. No. Yes.
Yes.
I did say yes.
I know.
That was crazy.
Yeah, but then you said no, which indicates you were guessing. That's okay.
It was a long day.
Yeah, if you never fail, it means you never tried, right? Exactly. Yeah, there's an appendix about that. Look at the appendix to Chapter 8 when they look at some fact situation that involves tax aspects. Of course, if the tax aspect is the same between alternatives, we can ignore it, right? Because as we learned from Chapter 7, if there's something that doesn't make a difference, if the tax effect is exactly the same between option A and option B, we can forget it for purposes of determining whether we should go with option A or B. But where something might have a tax attribute, either a subsidy of some kind or a deductible feature, and another option doesn't, then it is important to look at the tax aspect. So we have to take the tax rate into account. Cost reduction, another one. Should we spend $100,000 on a new machine if it can save us $5,000 a month? How long does it take us to get our investment back? If we spend $100,000 today and we can save $5,000 a month, how many months does it take to recoup our investment? Invest $100,000, save $5,000 a month. How long does it take to get our $100,000 back? Come on, guys. Will somebody please say 20 months? Thank you. Yeah, you invest $100,000 in a piece of equipment that'll save you $5,000 a month. It takes you 20 months to get your investment back. Is there a name we can plug into that or label that kind of calculation with? Does the book have a special name for that kind of calculation we just did? Payback. Yeah, it's a payback period. Yeah. There are at least one advantage and one disadvantage of the payback method. What's the advantage of the payback approach, the payback calculation? May begin with E. A. Yes.
Easy.
Easy. Yeah, that's it. Payback method is easy. All we did was divide 100,000 by 5,000, right? You invest 100,000, you save 5,000 a month in operating costs. How long does it take to recoup your investment? 100,000 divided by 5,000, 20 months. That's the advantage of the payback method. Can you think of at least one disadvantage of the payback method?
It can be misleading.
Yeah, it's not a true measure of profitability. We don't take the present value into account. And once we've met the payback, the 20 months or whatever it is in that example, we don't look at any cash inflows or outflows after we get to the payback period. So there are numerous disadvantages, but there's at least one advantage, that is it's easy to calculate. And when I was in some of the former Soviet republics and the East European satellite countries, they used payback a lot because there was so much uncertainty. They wanted to make a profit, but they were more interested in just recouping their initial investment so that they didn't lose money. And so even though the payback method has a lot of deficiencies, a lot of people use the payback method because of risk. They want to get their money back fast before conditions change or before they have to get out of the country or something. So the payback method is used in the real world. It's used in the United States too, but it's especially used in parts of the world where investments are at risk, like all of the former Soviet republics and Eastern Europe and, well, a lot of third world countries too. Except we don't call them third world anymore, right? It used to be third world. Yeah, developed or developing. Yeah, we got rid of the third because, you know, during the Cold War, there was the Soviet Union and its allies and the United States. Those were the first two. And any country that didn't fit within one of those realms was a third world country. But now that the Soviet Union has collapsed, we have developed and developing. It's new terminology. Well, new since 1991, not that new. That won't be on the CPA exam, by the way. I'm just trying to enrich the class, you know? I mean, accounting is exciting, but it's even more exciting when you combine it with political history, right? Maybe. Well, we'll see. Capital budgeting tends to fall into two broad categories. One of them is screening decisions. Does a proposed project meet some preset standard of acceptance? One of those standards might be, are we going to get our money back within 5 years? Another one might be, are we going to make at least 15% on this? Those would be the screening criteria. And if it doesn't meet one of those, whatever criteria we have, then that screens them out. You know, we have 20 investment decisions, let's take the 5 top. Or how many will make at least 15%? Or how many will pay us back within 5 years, or 3 years, or 10 years, or something? The other one, preference decisions, selecting from among several competing courses of action. We have 5 projects to consider. They each cost $100,000, and we only have $300,000 to spend. So we'll take the top 3 and we'll forget about number 4 and 5. So preference decisions, which projects should we invest in? Again, the nice thing about these textbooks, they tell you what you're going to get back. You don't have to estimate. You don't have to guess. I mean, think about it. If you're opening a restaurant someplace, do you have any idea how much money you're going to make? Even if you're in the restaurant business, it's a big guess, right? Yeah, we don't have any of that in the book. They tell us how much we're going to make. So that makes it easier. Because otherwise, we wouldn't be able to get very far. Cash flows versus operating income. Here we have a couple interesting little below the radar kinds of theories. Cash flow means cash in minus cash out. Then you have a positive cash flow, hopefully. Operating income is based on accrual basis income. Remember the difference between the accrual method and the other method? What's the other method? If it's not the accrual method, it's the, begins with C. A, S.
Okay.
Cash method. Okay, the cash method, yeah. So with the accrual basis method, what you learned in the financial accounting class, that's the accrual method is what we have to use for our public statements, our annual reports, our quarterly statements. For the accrual method, we recognize revenue when it's earned, not when it's received. We deduct expenses when they're incurred, not when they're paid. That's the accrual method. If we were on the cash basis of reporting, we'd recognize revenue when we receive the cash. We deduct the expenses when we pay. That's the difference. So we run into some problems with that in this chapter. They don't emphasize it though. These methods focus on analyzing the cash flows associated with capital investment projects. So basically for chapter 8 purposes, we're going to be pretty much on the cash method. And I say pretty much because we're still dealing with accrual basis figures sometimes. The payback method is one method. We just sort of gave some examples on that. Net present value. Whenever you see the word net in accounting, it means something has been subtracted. What's subtracted in the net present value calculation? I think I heard you say cash inflow minus cash outflow. Is that what you said?
You have really good hearing.
Yeah, that's good. Yeah. Sometimes I tune it out, but today I guess I'm okay. Yeah. Yeah. Net in accounting means something's been subtracted. So when we're talking about present value, what's the present value of future cash inflows? What's the present value of future cash outflows? And again, this whole present value concept begins with the premise that $1 today is worth more than $1 sometime in the future. If you had $1 today and invested it in the future, you'd hopefully have more than $1. How much more? Well, if you invested at 10% for 1 year, you'd have $1.10. So the present value of $1.10 in a year is $1. That's basically it. So if you had a business undergraduate, major or minor, you probably ran into that concept 2 or 3 or 4 times, maybe more. So this is hopefully a review. Internal rate of return is another way of looking at things. It's basically what kind of money are we making on this? Are we making 15% or 20%, whatever that internal rate of return is? Oh, yeah, there's a destructive force in the class. Okay, calm down. The simple rate of return method focuses on incremental net operating income. And simple rate of return ignores some things, which we'll get into. So let's start getting into those. Typical kinds of cash outflows: repairs and maintenance, you have to pay money, so the cash goes out. Working capital, you have to put money into a business, like you have to pay salaries and things like that, other expenses, that would be working capital. Remember what the definition of working capital was in the financial accounting class? What was it? Anyone remember? Working capital is something minus something else in financial accounting.
Oh, working capital. I know what it is.
Don't hold us in suspense. Tell us. Yeah, working capital is something minus something else.
Current assets?
Yes, yes. Yeah, current assets minus current liabilities. Yeah, that's working capital. Yeah, and that's pretty much what we're talking about now. If you start, let's say, a restaurant, for instance, you have to have working capital to start up. You have to pay the rent, electricity, utilities, you have to pay the help, all of that stuff. And the cash may not start flowing in for a while, or maybe the cash doesn't flow in fast enough to cover your expenses for a while. So you have to have some startup money. So that's what they're talking about, or that's what they mean when they say working capital in Chapter 8. Then the initial investment, you know what that is. It's just what you need to get into the business. And then you have incremental operating costs. Those would all be outflows. Inflows would be the release of working capital. Let's say after a certain amount of time, you can retrieve that working capital, take it out of the business, or if you're closing down an operation, you can take back the working capital you put into it some years before. That would be a cash inflow. And so if you plan to do something for 10 years, at the end of 10 years, if you can get the working capital back, you have to ask yourself the question, what's the present value of getting that money back in 10 years using some discount rate? Salvage value, if you have a delivery truck, you plan to use it for 5 years and then sell it for $20,000, what's the present value of getting $20,000 in 5 years? That would be a salvage value thing. Reduction of cost. Here it says cash inflows, but reduction of cost is really a negative outflow, isn't it? Yeah. If some machine is costing you $10,000 a month to operate, and you can buy a new one for $7,000 that would have operating costs of $7,000 a month, you're really saving $3,000, right? Current operating cost $10,000, you buy a new machine, operating costs will only be $7,000. You're saving $3,000 a month. that's like a cash inflow. In substance, it's really a negative outflow. So two negatives make a positive. Negative outflow is treated like a cash inflow. And incremental revenues, if you have a donut making machine or something, and it can make a new kind of donut, you can sell an extra 1,000 gross of donuts or something, 1,000 dozen donuts. You get incremental revenue from investing in a new piece of equipment or something. So those are some examples of inflows. The time value of money, again, $1 today is worth more than $1 in the future. And so we went over that. So, determine the payback period. Okay, they start off with the easy stuff, right? The payback method focuses on the payback period, which is the length of time that it takes for a project to recoup its initial cost out of the cash receipts that it generates. Or stated in simpler terms, how long is it going to take before we get 100% of our investment back? So you take the investment and you divide it by the annual net inflows. And we ignore a lot of stuff like time value of money. And there's what the payback method looks like. That's the cash coming back in. The payback method analyzes cash flows. However, it does not consider the time value of money. That's one of the defects, one of the deficiencies of the payback method. When the annual net cash inflow is the same each year, this formula can be used to compute the payback period. In a lot of these examples, we'll assume that the cash flow is the same every year. If that's the case, we just take whatever the investment is and divide it by the annual net cash inflow. So if the revenue is 30,000 and the expense is 20,000, the net cash inflow would be 10,000, right? Revenue is 30, expenses are 20, so the net cash inflow is 10. So whatever the investment is, divide that by 10,000, that'll give you the payback period in terms of years, if you're talking about annual cash inflow. If it's monthly cash inflow, then it would be the number of months. You can only use that formula, though, when the net inflows are the same for each period. They could be different. Now, let's say in the first year, you're only getting 5,000 cash flow, in the second year, 25,000, next year, $32,421.12. You see where I'm going with this, right? Mm-hmm. Yeah, you can't use this formula if the cash flows are not the same every year.
Are there scenarios where they would be? I mean, won't they always vary?
Oh, yeah, they would always vary. But if we're dealing with estimates anyway, why not just pretend that they're the same every year? Again, these are textbook examples, not real world stuff. But in this chapter, they show you how to do it both ways. If you expect the cash inflows to be the same every year, you can use the formula. If you expect them to be different each year, we can deal with that too and still figure out how long it takes. Basically, it's answering the same question. How long is it going to take to recoup my investment? If the investment's $100,000, how long is it going to take to get that $100,000 back after I pay my expenses? So management at the daily grind. I think we've all worked there at one time. At the daily grind, maybe some of you work there now. Wants to install an espresso bar in its restaurant. It costs $140,000 and has a 10-year life. Will generate annual net cash inflows of $35,000. Management requires a payback period of 5 years or less. Are they going to get their money back in 5 years? Yeah, cash inflows $35,000 a year. It costs $140,000. How long is it going to take to get $140,000?
4 years.
4 years. Yeah, $140,000 divided by $35,000. Or you can chop off 3 zeros, 140 divided by 35. Or you can use a calculator. Yeah. Yeah, management requires a payback of 5 years, and they get it back in 4 years. So they'll go with it. So the payback period is the investment required divided by the annual net cash inflow, so that's 4 years. 5 would have been okay, but 4 is even better. Consider the following 2 investments. We have project X and Y. The initial investment's the same, $100,000 for each. First year cash flow is the same, inflow, $1,660 for the first year. The second year, 40 versus 35. And I don't know what this other one is, years 14 through 10. I think that's a misprint. Can we agree that that's a misprint? Year 14-10, if it's not a misprint, I don't know what that means. So somebody didn't get that when they proofed these things. Probably years 3 through 10 would be my guess. So 14 is really 3. Let's go with that. In Project X, there are no cash flows after year 2. Project Y, 25,000 a year after year 2. Let's say years 3 through 10. So which project has the shortest? Well, there's a mistake there. What's the mistake? In order to have a superlative, you have to have at least 3 in the sample size, right? So shortest, they mean shorter. We'll forgive them because they're accountants. You should always forgive accountants, right? Just try to ingrain that in you. So what do we have? The initial investment, 100,000. In the case of Project X, you get 1640. So at the end of year 2, you've recouped your $100,000. So the payback for Project X is 2. Project Y, 100 minus 60 minus 35, that's 95. So there's still 5,000 that you didn't get back yet at the end of year 2, right? 60 plus 35, 95, you need 100. So that's going to go into year 3, and you can get it into year 3 because you're getting 25,000 a year for each year after year 2. And if you need 5 and you get 25, so 20% into year 3 would be the payback here. So it'd be like 2.2 years, right? 5,000 out of 25 is 20%. So 2 years plus 2/10, 2.2 years. And so Project X is obviously the better investment because the payback is quicker. Project X, 2 years. Project Y, more than 2 years. Therefore, we choose Project X, right?
You said the better investment, but did you mean the shorter payback period? Technically, the better investment would be the one that yields longer than.
Let's agree on something here. I'm trying to set you up. It's a trick question. And you saw right through it, right? Yeah. If I ask which one is the better payback period, the answer is X, because the payback is exactly 2 years. If I said which one is a better investment, you would say Y. Because even though Y takes 2.2 years to get the payback, you're going to get money for 10 years. Years 3 through 10, you're going to get 25,000 a year. So the better investment is Project Y, but the one with the shorter payback is Project X. Why do you think the author gave us this example? To highlight one deficiency of the payback method. Yeah. Yeah, the better investment is Project Y. The one with the shorter payback is Project X. So I think this is a really good example because it highlights one of the deficiencies of the payback method. Once you reach that payback, you don't look at any future cash inflows. That's one of the major deficiencies of it. How can we overcome that deficiency? Is there any method that you've studied in Chapter 8 that takes all cash flows into account, not just up to the payback method or period? Just about all the other ones in Chapter 8 do that, right? Yeah. So again, one major deficiency of the payback method is you don't look at future cash inflows once you've reached the payback period. Another deficiency, you don't take present value future cash flows into account. But yet still, companies use it, people use it, as I mentioned. It's not a totally valueless calculation. In some cases, it's the only one they do. You know, especially, well, what if you're in an inflationary economy where you have like 200% inflation a year? Would the present value of future cash inflows be relevant? You don't know what the inflation rate is going to be. It might drop to 50% a year. It might go up to 4,000% a year. Do any countries ever have a 4,000% inflation rate? Yeah. Yeah. Zimbabwe had like, I don't even know, 100,000, 200,000, 300,000% inflation because they weren't collecting taxes. They were just printing money. Did I tell you about the Polish taxi cab example yet? I don't want to repeat myself. Yeah. I was in Poland in like 1993, 94, something like that. They had a high inflation rate, and you know those taxis, they have meters that ticks off every quarter of a kilometer or something. the guy running the taxi had a little piece of cardboard there and it said times 400 on it. So I was being charged 400 times what was on the meter because of high inflation. That's how you deal with inflation if you're a taxi driver in Poland in the 1990s. So if you're dealing in a highly inflationary economy, this present value stuff becomes a problem because you don't know what the inflation rate's going to be. But let's ignore that. That's too much real world stuff. And also we have a low inflation rate here, sort of. I mean, by world standards, it's low anyway. So anyway, which project has the shorter payback period? We already answered that one, Project X. And the solution, we already did that. So it's which project you think is better, Project Y. The valuation, some shortcomings, it ignores the time value of money, ignores cash flows after the payback period. Shorter payback period does not always mean a more desirable investment, which is what that exercise is all about. Strengths of the payback period, it identifies products that recoup initial investments quickly, serves as a screening tool because you can forget about some projects that don't give you a quick payback period, if that's what you're looking for. Identifies investments that recoup cash investments quickly. If we were to compare the investment strategy of companies in the United States with those of Japan, in which country do you think the payback period would be more important? United States versus Japan. United States, yeah. The United States has been criticized for having what they call a short time horizon, right? They want to get good information into those quarterly reports so it has a positive effect on stock price. Maybe you've heard about that before. The United States is known for that. U.S. companies, because we have to file quarterly reports if we're a publicly traded company, we want to show, there's pressure to show increased earnings per share, increased bottom line as a percent of something else. So there's pressure to have a short time horizon, and that carries over into having a short payback period. You know, if you know you're not going to make any money on an investment for 10 years, if you're a U.S. company, you might not make the investment. If you're a Japanese company, that wouldn't matter quite as much because they have a different way of looking at things. They want to penetrate and get increased market share with profits sometime in the future. So Japanese companies, as a general rule, are more concerned with increasing market share, whereas U.S. companies are concerned with short-term bottom line stuff, annual reports, quarterly reports, and so forth. And that translates into the payback method. So U.S. companies tend to place a little more emphasis on the payback method than do Japanese companies. Was that in the book? No. I'm giving you high-value stuff here, folks. At no extra charge. Don't tell the dean, or she'll send you an additional invoice. Now we have a payback with uneven cash flows, which is quite often the case. When the cash flows associated with an investment project change from year to year, the payback formula introduced earlier cannot be used. Instead, we have to figure out what's the unrecovered amount. It's easy enough to do. All you do is you take your initial investment and then you subtract whatever net cash flow you get until you get to zero. And then you count how many years it took to do that. I wish they'd give us an example of that. Do you think they do?
Yes.
Oh, let's take a look at this one. For example, if a project requires an initial investment of $4,000 and provides uneven net cash flows in years 1 through 5, as shown, the investment would be fully recovered in year 4 in this case. So we evaluate the acceptability of an investment project using the net present value method. This is another method. What's one advantage of the net present value method? Pardon? Yes, it considers the time value of money. And so we have to use some kind of a discount rate. And the nice thing about these textbooks, they tell us what the discount rate is. We don't have to figure one out. What if we had to figure one out? Let's say you're in some situation at work and the boss says, what's the net present value on that thing? and the boss didn't tell you what discount rate to use, what would be a good rate to use?
Whatever the amount that they have to pay back. Their.
Did you say the company's cost of capital? That's what I thought you said. Yeah, the company's cost of capital. And there's a way to figure that out, right? Are we going to do that in this course, cost of capital? Yeah, they mentioned it sort of, right? It's basically if all you have is one bank loan, the cost of capital is whatever the interest rate is on that loan. But let's say you have 4 bank loans with different interest rates, different maturity dates, and also 3 bond issues, and you have common and preferred stock. Then it gets a little more complicated. We're not going to get into that in this course. You might get into that in the financial statement analysis class, which we only offer at the undergraduate level, unfortunately. Well, for now anyway. Oh, by the way, we're starting to expand our accounting curriculum in the MBA program. Now, it used to be we only offered 2 accounting courses, accounting 550 and 610. This is 610. Of course, I might also mention, if you're in a UNC university like this one, we're part of the North Carolina system, you can also take courses at any of the other UNC schools, and they have accounting courses too. But starting next semester, we're going to offer additional accounting courses. Like next semester, there's going to be one in international accounting.
Is it you gonna be the professor of all those classes?
Nobody else wants them, so it's me. Yeah.
Are you hiring an assistant?
Well, I have an assistant now. I have an assistant now, but I don't know when he's graduating. I do have an assistant because I have 160 students. Somebody's doing the grading, and that's my assistant. Yes?
But you said you grades not in because you didn't have an assistant. So you grade
Well, there's several things going on here. The accounting 550 section D45 ended on Friday, and I had to submit the grades today. But when I went to submit them on the regular system, I pushed the button and everything came out F. None of my students got an F. A lot of them got incompletes because it's an 8-week class, but none of them got an F. But when I pushed the button, everything was an F. So I canceled that, tried it again. They all came out F again. And in that one class, I had 31 students, and it only showed 18 of them on the screen. So what I did was I made a Word document, submitted it by email attachment to the registrar. So anyone who's out there who's in that class, whoever that might be, your grades were submitted, but not through the normal system, and you didn't get an F, either A, B, C, or incomplete. The incomplete could turn into an F, but it's up to you. Also, if you get an incomplete, you have until the end of the spring semester. And on the screen, it said you have until March 23rd. That's not true. You have till the end of the spring semester. So how did we get on that anyway? Oh, yeah, cost of capital. Okay. Well, cost of capital might be the discount rate to use. Within the financial analyst community, if there is such a thing, financial analysts look at financial statements, they do ratio analysis. Some of them say that the cost of capital is okay to use as a discount rate, but there may be a better rate, and that would be the incremental borrowing rate. Have you ever heard of that? Incremental borrowing rate? No?
Can you not borrow it all at once?
It would be the rate you'd have to pay the next time you go to the bank, basically. So think about it. If you have a lot of net worth, let's say you have 100 million in assets, you don't have any liabilities, so your equity is 100 million. Banks love you because there's no debt. Your debt equity ratio is 0 because there's no debt. When you take out a loan, then your debt equity ratio increases, right? The more you take, the more you take. If you have a debt equity ratio like 70, 80, 90% or something, it looks like you're a risk. And so they'll charge you a higher interest rate, or maybe you won't even get the loan at all. So the incremental borrowing rate is the rate you'd have to pay the next time you go to the bank. That may be a better indicator of what discount rate you should use. In the textbook, not just this one, but a lot of textbooks, they use cost of capital as the surrogate discount rate. But here they just tell you what the discount rate is. But if you ever got an assignment on the job and the boss asked you to figure out the present value, the easy way out is to ask the boss, what rate should I use? If the boss says, I don't know, then you can use the weighted average cost of capital. Just trying to make your life easier, folks. Because if the boss gives you a rate, you don't have to justify the rate you chose, right? You can blame the boss. So it's the rate you gave me. Just a practical little tidbit. So anyway, when we're talking about net present value, again, net means something has been subtracted. It's the present value of the future cash inflows minus the present value of the future cash outflows. We have some simplifying assumptions. All cash flows other than the initial investment occur at the end of the period. Well, we know that's not true, right? You don't pay your mortgage on December 31st. You have expenses throughout the year. Let's pretend that all the inflows and all the outflows occur at the end of the year, December 31st. Because otherwise, you can't use the tables on page, whatever that page is. And I have a paper clip on that page. 379 and 380 are the two pages where the present value tables are on. And by the way, you can bring those to the exam. They don't count as the one page of notes. So make photocopies of those present value tables. You can bring them to the exam.
I forgot, did you say it's one-sided notes?
Yes,
Okay.
one side. 8.5 by 11 inches, not feet. Somebody sent me an interesting article about that. Because a professor gave them parameters like 8.5 by 11 or something, but he didn't say inches. So somebody came out with feet. That's why I'm saying inches. Or A4 paper if you're outside the United States, because that's metric system stuff.
Are we allowed to use Excel or no?
Not on exam 2, no. Yeah, we're doing it the old-fashioned way. Yeah, pen, pencil, calculator. Yeah, can't call KPMG. Not for exam 2 anyway. So 2 simplifying assumptions. All cash flows other than the initial investment occur at the end of the period. That's the assumption. Again, not true, but we'll assume that it is. And the second one, all cash flows generated by an investment project are immediately reinvested at the rate of return equal to the discount rate. That may not be the case either. What if the prime rate is 3% and you're making 18%? You might only be able to invest something at the prime rate unless you keep pumping it into similar projects. Let's forget about that possibility. That's a simplifying assumption because otherwise we won't be able to use those tables. Lester Company has been offered a 5-year contract to provide component parts for a large manufacturer. So the cost of special equipment is $160,000. That would be a cash outflow. And what would be the discount factor for that one? Let's say that they're going to use that equipment for 5 years. What would the discount factor be on that $160,000?
On that table?
Well, the mere fact that you're looking at the table means I succeeded in setting you up again.
Sure.
I tricked you, yes. How did I trick you this time? This is initial, right, on day 1. We only use the tables when time has elapsed. And this is, I know you hate me. I can see it in your eyes. But every time I trick you, it makes me feel good.
I'll take it. I'll just
Yeah,
take it.
it's psychic income. The IRS hasn't figured out a way to tax that yet. So cost of special equipment, that's an outflow on day 1. So you don't discount that. And working capital required, that's an outflow on day 1. You don't discount that. Relining the equipment in 3 years, there's the discount. What's the present value of receiving $30,000 in 3 years or paying $30,000 in 3 years? That would be discounted at whatever the rate is for 3 years. And salvage value of the equipment in 5 years. What's the present value of receiving $5,000 in 5 years? We discount that. And the annual cash revenues and costs, sales revenue, cost of parts, salaries. What you can do here instead of figuring out the present values of all 3 of those, the 750, the 400, and the 270, just take 750 minus 400 minus 270, and then figure out the present value of that. 5 years based on whatever discount rate. Save some time. So at the end of 5 years, the working capital will be released and may be used elsewhere. So You begin here with the assumption you're going to get it back in 5 years. What's the present value of getting that back in 5 years? Unless your company uses a discount rate of 11%. We won't ask where that comes from. It might be the weighted average cost of capital. Maybe the boss says, oh, let's try 11%. Whatever it is, we're going to use 11%. Should the contract be accepted? So let's say that we do the number crunching and the number we get is $200. Should we make the investment? We do the number crunching. The bottom line is $200. Should we do it? Should we make the investment?
If the opportunity costs.
You're improving now. You're giving me answers. Yeah, you're giving me answers that I cannot say are wrong. Yeah, that's right. If the number is positive, it means we're getting more than the discount rate. The discount rate here is 11%. So if that's a positive $200, 200 doesn't sound like much. But if our minimum rate of return that we want is 11%, and that's $1, we'll take it because it's more than 11%. If we come out with something that's 0, what's our rate of return? It's exactly 11%, whatever the discount rate is. If it's negative, then we don't take it because we're not getting the 11% that's the minimum demanded. Or we can change our mind and say maybe 10% will be acceptable. So, but here it's with 11%, and it's nice, simple, straightforward. If the present value is 0 or greater, then we're making at least 11%, and we'll do it. Otherwise, we won't. So the annual net cash inflow from operation, $750, and minus costs, we have $80,000 to work with. That's the annual net cash inflows. So assuming those inflows occur on December 31st for each of the next 5 years, what's the present value of receiving $80,000 a year for 5 years? It's going to be something less than $400,000, right? Now, why did I mention that? Sometimes, and I'm not accusing anyone in this class, but in prior classes, they come out with something that's more than 400,000. Yeah, you should not do that, right? If this is a 5-year project, and before discounting, 80,000 times 5 is 400,000, the number you come out with has to be less than 400,000. If it's more than that, you push the wrong button on your calculator. Now, the reason I mention that is every semester, somebody or several people give me a number that's higher than 400,000 in this case, right? 5 times 80 is 400,000. That's before the discounting. The discounted factor has to be less than 400,000. So the investment in equipment, that's a $160,000 cash outflow, and it's not discounted because it's on day 1. And then the working capital needed, again, $100,000, that's not discounted because it's on day 1. We'd only discount if it's sometime in the future. And then for years 1 through 5, $80,000 a year. We take 80,000 times 3.696. Where does that come from? Well, there's a few ways we can do this. One way is to look at, I should maybe discuss these 2 tables. The table on page 379 is the present value of 1. The table on page 380, this is an annuity table. An annuity is a series of periodic payments. So let's say we have 5 payments at $80,000 a year. We would use table 8B2 on page 380. So it's another decision you have to make. There's only 2 tables, luckily, and you have to choose which of the tables to use in each case. In this case, because it's a series of periodic payments, $80,000 a year for 5 years, we would use table 2, the one that's on page 380. So let's take a look at page 380. The 11% column, 5 years. So we go to the 11% column, we go down 1, 2, 3, 4, 5, and we get 3.696. 3.696. That's where that number comes from.
I guess I'm confused. Why, so the 11% was given, right?
Right.
And that 11% represents what technically?
The 11% is the discount rate we're using.
So saying that the money's not going to be as valuable in the future at 11% per year?
Well, we could say that that's our weighted average cost of capital is 11%, if that's where they got the rate.
It's,
Or maybe that's the rate the bank charges on the loan. They don't really tell us where it comes from. It might be the weighted average cost of capital. It might be the rate the bank would charge us if we borrowed the money.
okay.
Cost of capital or something close to the cost of capital.
Oh, I see. So technically, if it wasn't losing any money, 80,000 in 5 years would be 400,000. But because we have to take the 11% out, then it ends up to be 295, 680. Okay.
Yeah, the present value receiving 80,000 a year for 5 years is 295,680. So, there's another way to do this. You probably want to know what it is, right? Because inquiring minds want to know. Yeah, I just made that up. I didn't hear that anywhere. If you go to the prior page, page 379, the 11% column, if you add up the first 5 figures in that 11% column, you should get 3.696. That's where that comes from. So if all you had was table 1, you could still do it. Just 80,000 times each of those numbers. Or you can add them up. Add up those 5, you get 3.696. Table 1, the first 5 numbers in the 11% column would be the same as 3.696. Table
And
2.
how would we know if we just had 2 tables like this, which one to use?
Well, if it's a one-shot deal, like the 160, you would even use a table. But let's say that in 5 years, you're going to get $50,000 back. That would be a one-shot deal. If it's a one-shot deal, you use the first table.
Okay.
If it's a series of periodic payments, like 80,000 a year for 5 years, that's a series of 5 payments. Then you'd use table 2, the annuity table. Some books have present values and future values, so you'd have 4 tables. Then you have to choose, except most of the examples use present values instead of future values. So a lot of times you can exclude the tables easily, but other times maybe it's not so easy to determine. So what do we have? So we have a negative 160, we have a negative 100,000, and we have a positive 295,680. Is there anything else to consider, or is that it? Do we just combine those 3 numbers, or is there something else? Well, the value of money is included in there, but what does the fact situation say? There's some other stuff going on there too, isn't there? Present value factor for 3 years. After 3 years, let's see if we can take this back. Relining the equipment in 3 years, $30,000. In 3 years, they're going to have an outflow of $30,000. What's the present value of $30,000? Discounted at 11%. Do we have any more things like that? Yeah, the salvage value in 5 years. In 5 years, we're going to get back $5,000. What's the present value of getting $5,000 in 5 years? Something less than that. We'd use table, which table would we use for this one, the 5,000? Table 1, because it's a one-shot deal. The 30,000, what table would we use for that? 1. Table 1, because it's a one-shot deal. It's not a series of periodic payments. And so we have these 2, we can call them complicating factors, I guess, or additional little things to consider. So the present value of the $1 factor for 3 years at 11% is 0.731. Where does that come from? That first table on page 379. So you go down to, on page 379, 11% column, 3 years, 0.731. That's where that comes from. So you multiply the dollar amount by the discount factor, and you get 2,965. And then the working capital that's released at the end of 5 years, you'll be able to use that working capital on something else. So what's the present value of receiving 100,000 in 5 years would be 59,300. And if you wanted to test your work, so this works. Yeah, this works. If you have 59,300 today, multiply that by 1.11 to the 5th power, and you should get 100,000. So I know those in cyberspace can't read this, so I'll tell you what I just did on the board. 59,300 multiplied by 1.11 to the 5th power. 59,300 times 1.11 to the 5th power should give you 100,000. That's where that comes from. Or, stated differently, 1 divided by 1.11 to the 5th power equals 0.593. That's where that comes from. So 1 divided by 1.11 to the 5th power gives you that 0.593. That's where that comes from in the table. So when we combine all these, if we get a positive number, we'll do it. If we get a negative number, we won't. Total present value, the release of the working capital and others, salvage value of the equipment, 62,265 when we add those two together. And so the net present value is positive, 76,015. All that means is that we're making more than an 11% rate of return. There's a way to figure out what the percent is, but as long as this is 0 or above, we'll do it because our minimum rate of return we've decided would be 11%. Since this is a positive number, so it's more than 11. You could do a trial and error, use 12% and see if it's still positive, use 15%, see if it's still positive. If it starts getting negative, then use the lower rate of return until you get this close to 0. Or if you have a fancy highfalutin calculator, you can punch in some numbers and it'll come out. So we know we're making more than 11% because it's 76,015, which is higher than 0. Questions? Maybe I should ask, how many people have had this kind of stuff at least once before? Show of hands. 1. How many at least twice? Oh, nobody's had it more than once? So this is sort of like a new stuff. Oh, okay. I just assumed you had it 3 or 4 times. Now, if you have questions, be sure to ask. Quick check, net present value method. Denny Associates has been offered a 4-year contract to supply the computing requirements for a local bank. So the cost of the computer equipment, $250,000, that's an outflow on day 1, so we don't discount that. Working capital required, $20,000, also on day 1, so there's no discount on that outflow. Upgrading the equipment in 2 years, we have to ask ourselves the question, what's the present value paying out $90,000 in 2 years, given some discount factor. And salvage value of the equipment in 4 years. In 4 years, we're going to receive $10,000 when we sell the equipment. What's the present value of receiving $10,000 in 4 years? And then the annual net cash inflow is $120,000. So that's a series of periodic payments. We would use table 2 for that one. The working capital would be released at the end of the contract. So we'd get that back. We'd have to ask ourselves the question, what's the present value of receiving $20,000 at the end of the contract? And here they're using a 14% discount rate. So we would use the 14% column. I won't ask you to do this in your head. What's the net present value of the contract? $28,230. There's that 230 again. So again, for the first 2, there's no discount because it occurs on day 1. We invested in the equipment, $250,000 on day 1. So that's times 1.000. There's no discount. The working capital needed, assuming we put it all in on day 1, that may not always be realistic, right? If you're building a building and it takes 2 or 3 years, you don't put it all in at once. You buy the materials as you need them. You pay for the labor as you need it and so forth. But let's forget all that. Let's say we put everything in on day 1, a simplifying assumption. And if we put in $20,000 on day 1, there's no discounting. We multiply it by 1.000, no discount factor because it's on day 1. Annual net cash inflows year 1 through 4, $120,000. There we have the discounting factor, and it's a series of periodic payments. So here it says 11. Didn't they say 14?
Yeah.
They did. Oh boy. They did say 14, didn't they? Yeah, 14. So, well, let's see. Yeah, we'll look at the table on page 380. We'll look at the 11% column for 4 years. Is this 4 years?
Yeah, 2.9
For-
reports, right?
Okay, so the mistake in the table is that this should say 14% instead of 11. The actual calculations are correct. The table here says 11%, but it's really 14, so just change that to 14. The calculations are correct. So years 1 through 4, 120,000 times the present value, 2.914. So that's 349,680. And upgrading the equipment 2 years from now, what's the present value paying out 90,000 in 2 years? That'd be 0.769. We'd use table 1 for that because this is a one-shot deal. It's a one-shot payment, not a series of periodic payments. So we multiply that, we get 69,210. Salvage value of the equipment. At the end of year 4, we're going to receive $10,000. What's the present value of receiving $10,000 in 4 years? That would be 5,920. Discount factor from table 1, 0.592. The reason it's table 1 is because it's a one-shot cash inflow or outflow, inflow in this case. And when the working capital is released in 4 years, we're going to get $20,000 back. What's the present value of receiving $20,000 in 4 years? $11,840, using the 14% discount rate. So when we add all that together, the net present value is a positive number. So should we do it? If it's a positive number, the answer is yes, we should do it, because it means we're getting more than a 14% rate of return. If the answer is 0, what percent rate of return are we getting? It's exactly 14, right? And if it's a negative number, then we're getting something less than 14. So either we don't take it, or we would reevaluate whether we should maybe accept a lower rate of return. What if the bank lends us money at 8%? If the bank lends money at 8% and we make 13, we're making 5% on the bank's money, right? So maybe we could do that anyway. If we only make 13 and we want 14, but if we can make 13 and we get the money from the bank for 8%, we're making 5% on the bank. So we should keep doing that as long as we can make more than what the bank charges. But they don't get into any of that. That's why I have to raise that, because it's additional free information. Again, net present value. Let's look at another way to calculate the net present value. Lester Company has been offered a 5-year contract to provide component parts for a large manufacturer. So the cost of special equipment at 160 is an outflow on day 1. Working capital required, 100,000 outlay on day 1. Relining the equipment in 3 years, we have to figure out what's the present value paying out 30,000 in 3 years. Salvage value of the equipment in 5 years. In 5 years, we're going to get 5,000 back. So we use table 1 to figure out what's the present value of 5,000. And then those last 3 numbers we can combine, 750 minus 400 minus 270. Notice it's the same numbers. But they say there's another way to do it. I mean, we were thrilled with the first way. Now we're going to find a second way. At the end of the 5 years, the working capital will be released. Lester Company uses the discount rate here. They say 11%. Is it really 11%? So again, we start with, we don't discount those first 2. The investment in the equipment's day 1, so there's no discount because no time has elapsed. Working capital needed, that's all on day 1. No time has elapsed, so there's no discounting. It's 1.000. Since the investments in equipment, 160,000, and working capital, 100,000 occur immediately, the discount factor is 1.000. It sounds like I'm repeating myself a lot, but there's a reason for that. If this is the first time you've had this, maybe, you know, if it didn't sink in the first or second or third time, if I say it 10 times, it'll maybe sink in. So it's not that I'm just babbling, or maybe I am, but sometimes there's a reason why I repeat myself. There's 2 reasons, either because it's worth repeating or because I forgot I already said it. So you can just assume I'm doing it for your benefit, not because I forgot that I just said it 5 minutes ago. It's my attempt at humor. Everyone in the first row needs to laugh now. There we go. I'll take a smile. That's good enough. So we know how this works, right? But now look at, there's a whole bunch of new lines here that we didn't have before. Remember before we used table 2 for some of that stuff? We don't have to use table 2. We can use table 1 for everything.
You have to do it more times.
Yeah, we just have more numbers to multiply and stuff. So the first few lines are the same, 160,000 times 1, 100,000 times 1. Oh, by the way, make sure that the subtractions are in parentheses, because another common mistake that students make, they add stuff when they should be subtracting it sometime. And sometimes the answer is A, B, C, and D. They'll take that possibility into account, so watch out for that. Then the annual, here we have, oh, look at this. It's supposed to be 80,000 a year, right? So why is it 80, 80, 50, 80, 80? Why isn't it 80, 80, 80, 80, 80? Why is it 50,000 in year 3?
Salvage, or-
Well, there's that, so we're going to have some kind of a maintenance thing going on in year 3, right? 30,000. Yeah, 30,000, we're going to have to pay out 30,000 for something. So rather than do 85 times and then do 30 as a negative, the net cash flow, 50,000 coming in, 30,000 going out, we'll just make that 50 in year 3. So that's why that's 50 in year 3. So the first 2 years, 80,000, year 3, 50, years 4 and 5, 80,000. And then the salvage value, the present value of getting 5,000 back at the end of 5 years. And 100,000 when we release the working capital, the present value of getting 100,000 back in 5 years, 59,003. So when we combine all that, we get a positive number, 76,015, which means we're getting more than our discount rate, the 11%. We're getting more than 11 because this is a positive number, the bottom line. Questions? All these figures, the discount factors all came from table 1. So we don't really need table 2, but if it's a series of periodic payments, it can save us some time if we use table 2. It's just the authors want to show you that you don't need table 2. Table 2, all the numbers on table 2 come from table 1. They just add them up. That's all it is. Say, for example, the total cash flow in year 1, 80,000 multiplied by, we already covered that. So let's skip that. Once you've computed the net present value, you should interpret the results as follows. Positive net present value indicates that the project's return exceeds the discount rate, or negative present value means that you're getting less than the discount rate. So here's the general rule. Should you accept the project or not? If it's a positive number, you accept the project because you're getting a rate of return that's higher than whatever the discount rate is. If it's 0, it means you're getting exactly the rate of return that the discount rate is. If it's negative, it means your rate of return is less than the discount rate. Choosing a discount rate. The company's cost of capital is usually regarded as the minimum required rate of return. The cost of capital is the average return the company must pay to its long-term creditors and stockholders. So creditors would be like bankers, if you have a bank loan, or bondholders, if you sell bonds, issue bonds, or you could have some kind of a private placement debt or something. And stockholders would be, well, you know what stockholders are. So, and there's a complicated way to figure that out. And even if you don't have, if you don't pay dividends, you still have a cost of capital on your equity capital. It gets a little complicated, but we don't need to go into that in this book. So, this book is aimed at other things. So,
Managerial.
yeah, this is managerial stuff. That other stuff, where there's a cost of capital even if you sell shares of stock and you never pay a dividend. There's a cost of capital there, but the cost lurks beneath the surface, so to speak. You can't really see what the cost is, but it's based on opportunity cost theory. You remember that, right? Yeah. So there's a whole, like a half a chapter on that in some graduate books. So we don't have time to go into that, but I thought I'd mention it just so you know. Recovery of the original investment. Again, the net present value method automatically provides for the return of the original investment. Here's an example. Carver Hospital is considering the purchase of an attachment for its X-ray machine. No investments are to be made unless they have an annual return of at least 10%. Will we be allowed to invest in the attachment? So the cost is $3,169. The life is 4 years. No salvage value. You won't be able to sell it at the end of 4 years. and the increase in annual cash inflows is 1,000. So 1,000 a year times 4 years, 4,000. The cost is only 3,169. So obviously we should do it, right? She's getting more difficult to fool with each passing question. Yeah,
Nice to see you every
yeah, yeah. Well, I don't say too many nice things. Just ask my daughter. Now that's 43 and unmarried. Anyone out there who wants a green card, you know, I got the daughter. But there may even be a small cash reward. But anyway, to get back to this, you notice how I tried to set you up, right? 1,000 a year times 4 years, $4,000. Cash inflow, 4,000. Cash outflow, 3,169. It's an obvious take that deal, right? But it's not that obvious because it's over 4 years. We have to consider the time value of money, unless we use the payback method. If we use the payback method, then we would take it because 4,000 is more than 3,169. But we're not doing the payback method. That was a few pages ago. We have to figure out what's the present value of receiving $1,000 a year for 4 years. That's 10%. Yeah. So
Oh, we did that.
there it is. Now it's an outflow of 3,167, and it's not discounted because it's day one. And then annual cash inflows of 1,000, 1,000, 1,000, 1,000. And again, we assume this is all at the end of the year. If it's at the end of the year, there's no discounting for the first year. I might mention that that's also included in table 2, that fact situation, or that assumption. So when we add that up, it's 0.
So why is it 909 instead of without?
Oh, yeah, good point. Oh, that's right. Because it occurs at the end of the year, that should be 0.909. Yeah, good point. Now, remember I told you last week when it appears that the professor has made a mistake, it's really just a test to see if you're paying attention? This is one of those cases. Or I could say you got me on that one.
Yes!
Not that it's a contest, but
Yeah, I think the book says 0.9.
yeah, 0.909. Yeah. Okay. So that's the reason this is 0.909 is because in the second line under the 10% factor, those in cyberspace can't see what I'm pointing at here, so I mentioned that. The 10% factor column, the second line, 1.000, it should be 0.909 because it's discounted for 1 year. The payments are at the beginning, or at the end rather, at the end. If it were 1, we'd assume they were at the beginning. So when we combine all the present values of the inflows and outflows at 0, so what rate of return are they making? They're making 10% rate of return, right? Yeah. If the net present value is exactly 0, the rate of return they get is the same as the discount rate, which is 10% in this case.
So why can't they just combine accounting and finance? Because this right here is finance.
Yeah, this is sort of
It's
finance.
just confusing.
It's also applied microeconomics. If you wanted to draw a Venn diagram, and we all do, right? Yeah, it's accounting, it's finance, applied microeconomics. It's all 3 in 1. But you're only getting charged for 1 course. You know, if the dean knew, she'd charge you for 3 courses. So we'll keep that our secret. Evaluate the acceptability of an investment project using the internal rate of return method. Similar to the net present value method, it's sort of like a cousin, I guess, because you have discount rates. It takes the present value of future cash inflows and outflows into account. The internal rate of return is a rate of return promised by an investment project over its useful life. It is computed by finding the discount rate that will cause the net present value of a project to be 0. So here we ask ourselves the question, what discount rate do we have to use to get this to 0? It works very well if a project's cash flows are identical every year. If the annual cash flows are not identical, a trial and error process must be used to find the internal rate of return. Or if you have a fancy highfalutin calculator, if you know which buttons to push, you can get it that way. So the general decision rule, if the internal rate of return is equal to or greater than the minimum required rate of return, we accept it, otherwise we reject it. And when using the internal rate of return, the cost of capital acts as the hurdle rate. This is just a term that they use. It's in accounting and finance. the hurdle rate that a project must clear for acceptance. The hurdle is something you have to jump over, right, and track. It's the same concept. Decker Company can purchase a new machine at a cost of $104,320. It will save $20,000 per year in cash operating costs. The machine has a 10-year life. So we take the investment required, $104,320, and we divide it by the net inflows, $20,000. We get 5.216.
Years? Is that years?
No, that's just a number. But that number probably appears on page 380 somewhere. What do you think? And going back here, it says the machine has a 10-year life. So let's see if we can find that on page 380, because this is a series of periodic payments, so we use the annuity table for line 10. Let's just go to the right until we find something that looks like it's close to 5.216. Do we see anything there that's close to 5.216? And looking at page 380, line 10, just keep going to the right until you see a number that's close to 5.216.
Yeah.
Yeah, that's under the 14% column.
Exactly.
It's exactly, we don't even have to interpolate here, right? If it were between, then we'd have to figure how close is it to this one or that one. We don't have to do that. It's a straight 14%. So that's the rate of return, 14%. Page 380, line 10, just keep going to the right, to the right, to the right, until you get to 5.216. That's under the 14% column. So that's where that comes from. You're getting a 14% rate of return. That's the internal rate of return method. So it's sort of like a cousin of the present value method, right? Present value method, they give us a rate, and then we say yes or no, we'll take it or not. Here, it tells us what the rate of return is. Then we have to ask ourselves, is that rate of return good enough? If it's higher than the cost of capital, then yes. So using the present value of an annuity, of one to, oh, we did that already. We just go to line 10, we keep going to the right until we see something that's close to 5.216. Here it's exactly 14%. If Decker's minimum required rate of return is equal to or greater than 14%, then the machine should be purchased. So the expected annual net cash inflow from a project is $22,000 over the next 5 years. The required investment,
Oh, no.
the required investment now in the project is $79,310. What is the internal rate of return? It's nice when they had that cannot be determined, right? Are you tempted to take that? Yeah. Well, you have 79,310 divided by 22,000. That's 3.605.
12%.
That's the present value over 5 years.
12%.
That's 12%.
Now, I get how to do that, and if I had a problem, I would know what to do, but why are we dividing 79 by 20?
Just to get the number that we need on the annuity table.
So you can
Yeah.
go look at
Yeah. So those in cyberspace, the question was, why are we dividing 79 by 22?
I get that, but I don't understand conceptually why the 79 divide, because I mean, that almost looks like the return rate, because the required investment now in the project is almost 80,000, and annually you get 25, so it almost looks like a payback. A little, like, am I confused?
Well,
Maybe
yeah,
payback is 3.6.
yeah, you can't really say it takes you 3.6 years to get your money back. Maybe it does. Let's see, 3 years would be, yeah, it might be close. If you get 22,000 a year, in 3 years you get 66,000. In 4 years you get 88,000. So it would be about 3.6.
So that's what I'm saying, so why are we dividing it?
Well, it's so that we can get the number on the present value of an annuity table, so we can find out what the discount
No, I
rate
guess
is.
what I'm saying, I get that, the number, we look at around here, but I want to know the why. Because like, if I had to read a whole paragraph, would I know to take that number and divide it by that number? Like, why is it those two divided by each other gives us this?
Well, it's the cost divided by the cash flow. So you have three factors. You could take the 22,000 times 3.605 to get 79,310. There's really three ways you can do this. You can take the 79,310 divided by 3.605 to get 22,000. If you have three variables, there's three ways you can do this. If you have two of the three variables, you can always figure out the third one by taking two of them and either dividing one by the other or multiplying one by the other, right? Just like in algebra, if you have 99 variables and you know 98 of them, you can always get the one missing variable.
Chairman, I think I'm just not wording well, but I get the
Oh.
concept.
Think of it sort of algebraically. Here we have three variables, the 79, the 22, and the 3.605.
In order to clear
Yeah.
another interest rate, just remember the project rate, the investment, the current investment divided by the cash inflow. And then the number you gave, always go to the table to figure out the.
No, I'm saying like I can figure that out, no problem, but I guess I don't understand why the investment now is divided by the net cash flow. I get the concept of it, not just the numbers themselves.
Oh, okay. Well, in the net present value method, we multiplied the 22,000 by the 3.605.
Yes.
In the net present value method, or the internal rate of return, method, again, it's the same three variables, except they give us one now that they didn't give us before.
Okay.
Instead of, in the net present value method, they didn't give us the 79,310. We had to get that by multiplying 22,000 times 3.605. In the net present value method, they did not give us the 79,310. In the internal rate of return, they gave us the 79,310, but they didn't give us the 3.605. So that's why I say the net present value method and the internal rate of return are like cousins to each other, because it's the same three variables. It's just that they give us one but not the other. So, yeah, okay. It's sort of neat from a mathematical standpoint. I mean, if you like algebra, that's maybe the gift. But that's all it is. If we have 2 out of the 3 solved for x with whatever the unknown is. Comparing the net present value and internal rate of return methods. Again, net present value is often simpler to use. Questionable assumption. Internal rate of return method assumes cash flows are reinvested at the internal rate of return. That may not be the case. Now, let's say you have a project, you're getting positive cash flow. What do you do with the money? You invest it in whatever you can to get the maximum rate of return given a certain risk ratio and so forth. It may not be the same as the internal rate of return. But let's forget that, because that's a complicating factor, and we wouldn't be able to use the present value tables if we didn't have the simplifying assumption. So let's just assume when you get the cash in, you can invest it at the same rate as the internal rate of return. And if you can't make that assumption, it gets more complicated. And you have to know what rate of return you can get on the new investment. So we're not going to go there. There's no objections, right? No, these are simplifying assumptions. If the internal rate of return is high, this assumption may be unrealistic. It is more realistic to assume that the cash flows can be reinvested at the discount rate, which is the underlying assumption of the net present value method. So again, we're making a lot of assumptions. There's a joke among economists. There's this economist in the desert, and he has a can filled with water. How does he prevent himself from dying of thirst? Remember, he's an economist. First, assume a can opener. Because that's a joke only economists would get. And economists assume away all kinds of stuff, right? Okay. Why do they call economics a dismal science? I don't know. I think it's exciting. Google it, by the way. Go to Google, type in economist jokes. You'll find a whole bunch of them, and they're all funny. Or maybe not. What do you think of that guy who won the Nobel Prize in economics the other day? Richard Thaler? Yes? No? None? None? Haven't had a chance to read his stuff? That's okay. He won for his work about irrational behavior. People don't always behave rationally when they make investments or when they do anything. A lot of times they're not rational in their investments. And economists would predict that they'd make choice A, but they really make choice B or C that may even be harmful, detrimental to them. But yet they make it anyway because people are not always rational. One of the basic theories in economics is you assume that the investor is a rational person or the individual is rational because not everything's an investment. But he proved, well, he not only proved, he discussed in great depth psychological reasons why people may be irrational sometimes. So when they ask him what he's going to do with his Nobel Prize money, it's a little over $1 million he's getting. He said, I'm going to spend it as irrationally as possible. So economics can be fun, right? I just have to find where the little fun tidbits are. But so there we go. Let's see. So what do we have? We will now expand the net present value method to include two alternatives. We will analyze the alternatives using the total cost approach. So we have the White Company. It has two alternatives. Remodel an old car wash or remove the old car wash and install a new one. The company uses a discount rate of 10%. So with a new car wash, their annual revenues would be $90,000. If they keep the old one they have, revenues are only $70,000. So by adding a new one, they can get an extra $20,000 in revenue. The annual operating costs would be $5,000 more if they get the new one, $30,000 instead of $25,000. And the annual net cash inflows would be $60,000 if they get the new one, or $45,000 if they keep the old one. So should they invest whatever's necessary to get the new one? The net cash inflows, 60 versus 45, it looks pretty good. It looks like they should get the new one. But is there really more to it than that?
No.
Yeah, probably, right? Or else there wouldn't be 6 slides with this. There'd only be 1. So if White installs the new washer, the cost is $300,000. Productive life is 10 years. Salvage value is $7,000. So the outflow in year 1 is $300,000. Salvage value in 10 years, what's the present value receiving? $7,000 back. And you replace the brushes at the end of 6 years. What's the present value of spending $50,000 in 6 years? That would be a present value using table 1. Salvage value, that's a table 1 figure. The cost, there's no table there because it's on day 1. Salvage of the old equipment, $40,000. The present value of receiving $40,000 today is $40,000. So there's no discount on that. And let's look at the present value of this alternative. You have a $300,000 outflow today, and because it's today, it's not discounted. Multiply it by 1.000. Make sure to put it in parentheses because it's an outflow. And then you replace the brushes in 6 years. What's the present value of paying $50,000 in 6 years? You go to table 1, 0.564. It's table 1 because it's a one-shot deal, not a series of periodic payments. So that's negative $28,200. The annual cash inflows, this is a series of periodic payments, so you would use table 2, 10,000 times, well, the present value for 10 years, 6.145 comes from table 2. And the salvage value of the old equipment, if you get the new car wash, you can sell the old equipment now, today, so it's not discounted. That's why that's 1.000. You can get $40,000 for that. Salvage value of the new equipment at the end of 10 years, you'll be able to sell that for $7,000. What's the present value of receiving $7,000 in 10 years? $2,702. So when you combine all of those, the net present value is $83,202. Since that's a positive number, should we do it? Yes, everybody agrees? Everybody agrees?
Oh,
Everybody agrees? It's a positive number. How can you say no? We obviously have to invest in this new car wash because $83,202 is more than 0, right? All right. Whenever I say, all right, at the end of the sentence with a question mark, you know I'm trying to set you up. And so you can either say no, or you can just remain silent.
Can we see the original question?
The original question?
Yeah, that'll help us figure out why.
Yeah, because by the time we go through all this, you forget what the original question is. We have 2 options. This is only one option. Don't we have to figure out the present value of the other option? You have 2 alternatives. New car wash, old car wash. But by the time we went through these slides and did all the calculations, maybe you forgot that there's 2 alternatives. You see this? It's greater than 0. 83,202 is greater than 0, so it looks like we should accept this deal. But that would be a premature judgment because we have to figure out what's the net present value of the other alternative? And whichever one has the larger number is the one we go with.
Is it 20,000?
I've been trying to drive her out for years. She actually left home at the age of 30, but she came back 8 years later. Long story. So anyway, if White remodels the existing washer, the remodeling cost is $175,000. That's an outflow today, so it's not discounted. And if they replace the brushes at the end of 6 years, that's an outflow in 6 years. So we have to take the present value of $80,000. Let's look at the present value of the second alternative. So we have an outflow of $175,000 today is not discounted. So it's just negative $175. Replacing brushes in 6 years, the present value of an $80,000 outflow in 6 years, $45,120. And the discount factor from table 1 is 0.564. It's from table 1 because it's a one-shot deal. It's not a series of periodic payments. And the annual cash inflow is $45,000. Since it's a series, that's in table 2, 6.145. So the net present value there, $56,405. So obviously we should take that because it's more than 0, right?
No, the other
All right. All right. No?
No.
What do we have to do?
one.
We compare this number to the other alternative, right? We could do this because it's 56,000. It's a positive number. But if the present value, the other alternative was higher, we should do the other. And so here we have both of them. If we invest in the new washer, the present value is a positive 83,202. If we just remodel the existing one, it's still positive, but it's less, 56,405. So we're ahead, 26,797. That's the difference in present value in favor of the new one. So we get the new one. This is like a multi-layered thing here, right?
Now we have 6 minutes to do it.
Yeah, well, isn't it 7 now or something? Yeah, but then it's, you know, they're not all this complicated. Some of them, on average, you could probably do maybe 3.
I'm just using Benny.
So, least cost decisions. What if you don't have any revenue involved? What if it's just a cost thing? You have the option of buying machine A or machine B. Machine A costs you $100,000. It can reduce your operating cost by $20,000 a year. Machine B costs $300,000, but it can reduce your operating cost by $60,212.11 a year.
Can you write those numbers on the table?
I already forgot what those numbers are. I make it up as I go along. Yeah, you're not supposed to question me because then you see the defects in my presentation. Right? I just make this stuff up as I go along. But the thing is, if you don't have revenues, you don't have like a present value factor where it's revenue minus expenses, positive, negative, or 0. So you just look at what's the present value of the cost. Whichever cost is lower, whichever number is negative by the lesser amount or the least amount, if you have 3 or more alternatives, that's the one you go with. All other things being equal. So Home Furniture Company is trying to decide whether to overhaul an old delivery truck now or purchase a new one. So the company uses a discount rate of 10%. So the old truck, if you overhaul it now, it costs $4,500 to do that. The annual operating costs are $10,000, and the salvage value in 5 years, somebody's going to pay you $250 for that. And so the salvage value now is $9,000. That can make a difference because if you buy the new truck, you'll get that $9,000. If you don't buy the new truck, you won't get the $9,000. The new truck costs $21,000. The annual operating costs are $6,000 instead of $10,000. Isn't this sort of like a positive inflow of 4? If you can reduce the operating costs from 10 to 6, you're saving $4,000. That's like an inflow, yes? It's a negative outflow. 2 negatives make a positive. A negative outflow is the same as a positive inflow. So we can think of this as a $4,000 positive inflow. 10,000 operating costs versus 6. 4,000 is not going out. It's staying there. So it's like a 4,000 inflow. Yes?
Take the 9,000 from the 21,000.
The 9,000 from the 21. Well, the thing is, with the 9,000, if you get the new truck, you can sell the old one for 9,000. So that would be an inflow of 9,000 today. If you keep the old truck, that 9,000 is a number we don't use. It's irrelevant if we keep the old one. But when you're thinking about buying the new truck, you have to consider the fact that you'll get 9,000 when you sell the old truck. That would be an inflow, but only for the new truck. Yeah, good point. And then the salvage value in 5 years, you can get 3,000. So what's the present value of receiving 3,000 in 5 years? So we work out the total cost using the present value tables. And what do we get? If we buy the new truck, the net present value is negative 32,883. So the purchase price today, 21,000, and annual operating cost 6,000 a year, discounted for 5 years. And the salvage value of the old truck, that's an inflow. What's a positive? And we don't discount that because it's on day one, the 9,000. Then the salvage value of the new truck, in 5 years, we're going to get 3,000. So the present value of receiving 3,000 in 5 years is 1,863. Whenever you see 1863, what do you think of? Think July 1st, 2nd, and 3rd. What happened? July 1st, 2nd, and 3rd, 1863. Something that happened in Gettysburg. What state is Gettysburg in? Begins with P. No? No? Pennsylvania. Okay. So what happened? July 1st, 2nd, and 3rd, 1863. Battle of Gettysburg. Who won? Or who came in second? No? Well, it's not going to be on the. Geez, you guys don't know your 19th century American history. Okay. So anyway, it's not going to be on the CPA exam. It doesn't matter. But whenever I see 1863, I think of stuff like that. What happened in New York in July 1863? They burned down 9th Avenue in Manhattan because they had a draft riot. Again, not on the CPA exam. Just, these little things just come to me. Sorry, I can't help it. But I'm functional. I can't make money from teaching history, so I teach accounting. So anyway, the net present value, 32,883. Since that's negative, then we don't buy it, right? Oh, we have to compare it to the other one. That's right. Because if we buy the new truck, it's a net cost of 32,883. But what if we don't buy the new truck? What if we just recondition the old one? Then the net present value for keeping the old truck is 42,255. So would we rather pay 42,255 net or 32,883? We take the 32. It's better to pay 32 than 42. So we don't keep the old truck, we buy the new truck. There's no revenues involved there, although there is that cash inflow sort of, because we're saving 4,000 in operating costs. So that's an example where we don't have revenues. We just have costs. Take whatever cost is the least or the lesser of the two. And they show the difference there. Again, net present value. If you purchase, you're out 32,883, or if you overhaul the existing truck, you're out 42,255. So you're saving 4,000 a year in operating costs. That's probably most of the difference. And then, plus the salvage value and all that. So you're ahead, present value 93.72 in favor of purchasing the new truck. So this is the kind of decision you might have to make in the real world. Let's say you're vice president of sales. You're thinking of replacing your 15 delivery trucks. You could do this very exercise to figure out should it be yes or no. So accounting is good even for marketing majors, right? If you're going to be vice president of sales, you can do this calculation to figure out if you need to replace your delivery trucks or just do something to the existing ones. Evaluate an investment project that has uncertain cash flows. Now you're dealing with uncertainty. Assume that all of the cash flows relate to an investment in a supertanker have been estimated except for its salvage value in 20 years. So again, we might have 6 variables. If we know 5 of those 6 variables, we can figure out the other one, right? Using algebra. Yeah, if there are 6 variables and we know 5 of them, we can figure out the other one. Using a discount rate of 12%, management has determined that the net present value of all the cash flows, except the salvage value, is a negative 1.04 million. How large would the salvage value need to be to make this investment attractive? There's a couple things going on here, right? You have to figure out not only the salvage value, but the present value of the salvage value. Or maybe the present value of the salvage value first, and then figure out the future value, because that's what we actually need, right? Don't we need the future value? That's what would the salvage value have to be at the end of 20 years? That would be the future value. It's a deceptively tricky little question. Well, let's start with this one. Net present value to be offset, 1,040,000, and the present value factor, 0.104. Where's that come from?
You go back.
Yeah, I'll go back. Salvage value in 20 years, discounted 12%. Let's take a look at Table 1, page 379.
Oh, there you go.
The 20-year line, 12%, 0.104. There it is. I'm looking now at Table 1, page 379, the 12% column, line 20, because it's 20 years, 0.104. So let's go back to here, 0.104. That's where the 104 comes from. And the 1,040,000, they already gave you that one. So that's 10 million. Is that all there is to it?
No, you figure out the salvage.
Well, that's how much salvage value we need, right? Unless there's something else to do. This equation can be used to determine that if the salvage value of the supertanker is at least 10 million, the net present value of the investment would be positive and therefore acceptable. So the fact that we're using the present value stuff means that's already been taken into consideration. So Bay Architects is considering a drafting machine. Are there any questions about that, by the way, before we move on?
Did you say it was negative 1 million?
Yeah, let's see, 1.04. Yeah, the salvage value is a negative. Everything except the salvage value is a negative 1.04 million.
Oh, okay. So
Yeah, and the salvage value would bring it into the positive column, or it'd bring it to the 0 column. It would really be 0, right? If you include the present value of the salvage value, that would bring it to 0. That would be the minimum amount they'd have to be able to sell it for in order to make this deal. So Bay Architects is considering a drafting machine that would cost $100,000, last 4 years, provide annual cash savings of $10,000. Well, $10,000 a year for 10 years would be $100,000, but this is only 4 years. And considerable intangible benefits each year. Now, intangible benefits can't be measured, right? So how large in cash terms would the intangible benefits have to be per year to justify the investing in the machine if the discount rate is 14%? Well, you can't really measure intangible values, but you can make an estimate. You know, like if you have a choice of buying a black car or a red car and you like the red car better, how much better do you like it? Is it worth an extra $500? If the answer is yes, then you can measure the intangible. Or how about 510, 505? You know, there's some kind of an intangible benefit of having a red car versus a black car maybe, or maybe green versus blue. But we can't really measure it, but let's try to do that anyway. So it costs $100,000, cash savings are $10,000 a year, and 4 years, and a 14% discount rate. So $24,317 is the answer, but where does it come from? Well, let's take a look. We have the investment in the machine. That's $100,000 outflow on day 1, so it's not discounted. The annual net cash inflow is $10,000 a year for 4 years, So it comes from table 2. You multiply that by 2.914, and then the annual intangible benefits, you don't know what that is. So you just sort of figure out. It's a negative 100,000 to positive 29,140, and that's when you combine those two, that's 70,860. We don't know what the intangible benefits are, but if we take that 70,860 and divide it by the present value of the annuity, 2.914, that would be 24,317. So the intangible benefits would have to be 24,317 in order to take this deal. I can tell by the expressions on your faces you don't like this one as much as some of the other ones.
The 24,000 is the present value?
Yeah, present value. That would be the intangible benefits that you would need in order to take this deal. Then it's up to you to decide, is that, yeah, that's okay, or it's not okay. But it's intangible, so it's a subjective value judgment involved. Yes?
So in every case, you use that figure?
Well, I hesitate to say every, because it depends on the fact situation. I mean, in this case, we would use it. But, you know, if they ask a different question, we'd do something else. Well, this is one reason why you have 3 quizzes with every chapter and not just one. And if I only count the highest grade, isn't that like a curve? No? It's a kind of a curve, right? If I give you 3 quizzes for each chapter and I only take the highest grade, that's sort of like a curve. So that way I don't have to give curves. Now, if you get 20, 30, and a 90, you get a 90. Rank investment projects in order of preference. Oh, here's a good one. You have a bunch of projects and you only have $100,000 or $100 million to work with. Some of them you're going to have to forego. You're not going to be able to take advantage of every investment opportunity because you don't have enough capital to invest in everything that might be profitable. So you invest in the ones that are most profitable. How do you determine what's most profitable? That's what this is all about. You rank the projects. And you have screening decisions pertain to whether or not some proposed investment is acceptable. These decisions come first. So some may not be acceptable at all. Now let's say that your cost of capital is 8% and some projects only return 5%. You're not going to do those, even if you have enough capital, because you lose money. So the screening process, first of all, you cross off the ones that you wouldn't take in under any circumstances. If your cost of capital is 8% and it only returns 5%, you're not going to take it. So screen those out. And then preference decisions. You attempt to rank acceptable alternatives from the most to least appealing. So if you only have enough money to invest in one thing, invest in the one that's most profitable. If you have enough money to invest in 3 of those 18 projects, take the ones with the 3 highest rates of return. So you just have to calculate what are the highest rates of return. That's what this is all about. So when using the internal rate of return method to rank competing investment projects, the preference rule is the higher the internal rate of return, the more desirable the project. The net present value of one project cannot be directly compared to the net present value of another project unless the investments are equal. You probably want an example? Okay, let's say project A has a net present value of 20,000. Project B has a net present value of 21,000. With project A, you only have to invest 50,000. Project B, you have to invest 2 million. Project B has the higher net present value, right? Again, project A, net present value 20,000. Project B, net present value 21,000. It looks like 21 is better than 20, so you might be tempted to say project B, this net present value for A is 20,000, net present value for project B, 21,000. But if for project A, you only have to invest 50,000, 20,000 out of 50,000 is 40%. If you have to invest 5 million for project B, 21,000 out of 5 million is a lot less than 40%. So that's what they mean by this. Net present value of one project cannot be directly compared to the net present value of another project unless the investments are equal. And in the example I gave you there, 50,000 versus so many million, the investments aren't equal. So you have to figure out another way to make the comparison. So we have this thing called the project profitability index. Here's how you would calculate it. It's the net present value of the project divided by the investment required. So we have two projects. Project A has a net present value of 1,000. Project B also has a net present value of 1,000. So you might assume that they're equally profitable, except the investment required for Project A is 10,000, whereas the investment required for Project B is only 5,000. So if you take 1,000 divided by 10,000, that's 10%. If you take 1,000 divided by 5,000, that's 20%. So you go with whatever the larger number is, or the largest if you have more than two. That's how you would determine the higher rate of return. If you're going to invest 10,000 and get a $1,000 back, you're getting a 10% rate of return. If you invest 5,000 and get 1,000 back, you're getting a 20% rate of return. That's all that means. And the higher the profitability index, the more desirable the project. So if you just move those decimals 2 places to the right and put a percent after them, that's an indication like 10% for project A, 20% for project B. That's all that means. So it's, if your cost of capital is 8%, if you had enough money, you'd take them both. Because if you can borrow at 8% and make 10, you're still making 2% on the bank's money. So this is without taking into account cost of capital. Let's say you have enough money to invest in these two projects and they're both profitable. Which one do you take first? And if you don't have enough money for both, but only for one, which one do you take? You take B, because 20% is twice as good as 10%. Compute the simple rate of return for an investment. Simple rate of return is simple, but it's also not as complicated. Simple rate of return method does not focus on cash flows, rather it focuses on accounting net operating income. Now remember, net operating income is an accrual basis number, right? Revenue is recognized when it's earned, not when it's received. Expenses are deducted when they're incurred, not when they're paid. The following formula is used to calculate the simple rate of return. So the annual incremental net operating income, which is an accrual basis number, has nothing to do with cash flow, divided by the initial investment. And there's a little asterisk there. It said the initial investment should be reduced by any salvage from the sale of the old equipment, in case there is salvage value. So management of the daily grind wants to install an espresso bar in its restaurant. It costs $140,000 and has a 10-year life. Will generate incremental revenues of $100,000 and incremental expenses of $65,000, including depreciation. And because we're including depreciation, it's an accrual basis number, because depreciation is not a cash flow thing, right? You don't write out a check for depreciation expense, so it's an accrual basis number. What is the simple rate of return on the investment project? 35,000 divided by 140 is 25%. That's simple rate of return without taking into account present values or any of that other stuff. That's why they call it a simple rate of return. Is there anything wrong with this simple rate of return? Well, here are some shortcomings. One of them, it ignores the time value of money. And also, the same project may appear desirable in some years and undesirable in other years. So, a few shortcomings. But the positive aspect is it's simple. That's why they call it a simple rate of return. Behavioral implications. And that's what Richard Thaler got the Nobel Prize in Economics for, right? Behavioral economics. So when investment center managers are evaluated using return on investment, ROI, the project's simple rate of return may motivate them to bypass investment opportunities that earn positive net present values. Everybody agree? Could you give me an example, or do you want me to give you an example? Yeah, I can give it. You allow me that? Okay. I have to find an eraser here. There's one. And for those in cyberspace, I'll repeat. This is. So let's say we have cost of capital is 8%, and okay, for those in cyberspace, since you can't see what I just put on the board, I wrote that the cost of capital is 8%, and we'll have two columns. In the left column, we'll have something called project, and we'll have A, B, C, and D. Project A, B, C, and D in the left column. In the right column, I have some percentages. For project A, the rate of return is 22%. Project B, rate of return is 15%. Project C, the rate of return is 12%. Project D, the rate of return is 5%. So we have these 4 projects we might invest in. Let's say that we have enough money to invest in all 4 of them. We can borrow as much money as we need at 8%. That's the cost of capital. The question is, which projects should we invest in? Does everybody agree we should not invest in project D? If we borrow at 8% and get a 5% rate of return, like we would for project D, we lose 3%. So we're not going to do project D. Should we invest in project A? Project A makes 22%, our cost of capital is 8. We borrow at 8, we invest, we get 22. That's 14% more than the cost of the capital. Everybody agrees we should invest in A, right? Should we invest in project B? Project B has a rate of return of 15%. We can borrow from the bank at 8%. We get 15% return. We're making 7% on the bank's money. Should we invest in project B? Well, the answer is only yes if you want to increase the bottom line. But based on what's on the screen here, they're talking about return on investment, ROI. If you want to maximize return on investment, you would only invest in project A, because it pays more than the other projects. You're getting 22% instead of 15. If your goal is to maximize return on investment, you would only invest in project A. Even though projects B and C are also profitable, because every time you invest in a project that's less than 22%, your ROI, return on investment, drops. And that's what this screen says, basically. It says, may motivate them to bypass investment opportunities that earn positive net present values. In other words, you know, if the boss tells you to maximize return on investment, you only invest in A, because if you invest in B and C, your return is going to go down, because it's going to be somewhere between 22 and 12. You know, if you invest in A and B, it's going to be 22 plus 15 divided by 2. That's 19 and a half, right? And if you invest in all 3, 22, 15, and 12, 49, let's see, if we have the 16 and a third, if you invest in all of those. So, I mean, the point is, there are 2 goals here, and they're conflicting goals. You either go for return on investment, where you get the highest rate of return, which means you only invest in the most profitable project, that's project A, or you try to maximize the bottom line, which means you'll invest in anything that pays more than the cost of capital. If the cost of capital is 8%, you'll invest in anything that's more than 8%. So on this slide here, where you evaluate projects based on ROI, return on investment, you could forego other opportunities like projects B and C. Those are profitable, but you wouldn't do those. You wouldn't invest in B or C if your goal is to maximize ROI, return on investment, which means maybe you shouldn't try to maximize ROI. Maybe you should try to maximize the bottom line. I throw that out for your consideration because this is a controversial subject in finance, not so much in economics, but in finance. And your ratios would be different too, you know, for purposes of financial statement analysis. So it's going a little bit far afield, but I figured I have to mention it because the authors don't give an example. And I think an example is sort of called for. So post-audit of investment projects. After the project is completed, you look back and you ask yourself the question, how did we do? You know, we thought it was going to get 22% rate of return. Did it really get 22% rate of return? You know, were our projections accurate? Either yes or no. But a post-audit just means you look at what actually happened. And then if it didn't turn out the way you thought it would, you have to ask yourself the question, why didn't it? What went wrong? What assumptions did we make that we shouldn't have made? That kind of thing. So that's it for that. Time to crunch some numbers. Yes?
So when you're trying to increase the bottom line, which one do you use the shortest?
Well, when you're trying to increase the bottom line, you'll keep investing in any project that makes more than the cost of capital. If the cost of capital is 8%, you would invest in A, B, and C in my example, because in A you make 22%, B you make 15%, and C you make 12%. So anything that's more than 8, if you want to maximize the bottom line, you know, wouldn't it be nice if you could borrow unlimited amounts of money at 8%? If you knew in advance what the rate of return would be, you would invest in anything that pays more than 8%, because then you're making money on the bank's money. Okay. Well, let's take a look at the homework. This homework stuff should be really easy now because we've gone through just about everything that's covered in the homework. Let's take a look at page 360. Page 360, exercise 1. Getting back to the easiest thing in the chapter, the payback method. Management of Unter Corporation, an architectural design firm, is considering an investment with the following cash flows. So they have cash flows for years 1 through 10. The investment in the first year is $15,000. The investment in year 2 is $8,000. And you'll notice the cash flows change every year. They're not the same. And remember, for the payback, you just take whatever the cost is divided by the cash inflows. It tells you what the payback is. You can only do that when the cash flows are the same every year. In this exercise 1, the cash flows are different every year, so we can't use the formula. But all we do is we take whatever the cost is and we subtract any cash inflows until that becomes 0, and that'll tell us how long it takes to get our money back. Yes?
I'm still a bit confused on how do you know which chart to use, the first one or the second one?
Oh, for the those present value tables? Okay, yeah, for the present value tables, the first one you would use when there's just a single event. Like let's say you're investing $100,000. That would be a one-time deal on day 1. If it's a one-shot deal, you would use table 1. You'd use table 2 if there's more than one inflow or more than one outflow. Let's say you'll get a positive inflow of $20,000 a year for the next 5 years. That's more than one. So you'd use the annuity table. That's table 2. So yeah, so if it's a one cash inflow or one cash outflow, you use table 1. If it's a series of inflows or outflows, you use table 2. Yeah. So let's look at the requirements for exercise 1. Determine the payback period of the investment. Well, let's take a look here. For the investment year 1, it's a $15,000 outflow and a $1,000 inflow. So the unrecovered investment is $14,000, 15 minus 1. The second year, you invest $8,000, so that's an $8,000 outflow. There's a $2,000 inflow. So that's a $6,000 net outflow. And you had $14,000 unrecovered in year 1. 14 plus 6 is 20. So at the end of year 2, you're $20,000 in the hole, so to speak. Every year after that, that number gets smaller. In year 3, you have a net inflow of $2,500. So that $20,000 minus $2,500, $17,500. And the next year, year 4, you have a $4,000 inflow. So $17,500 minus $4,000, $13,500. then minus 5,000 equals 8,500, minus 6,000, or yeah, minus 6,000 equals 2,500. Then in year 7, you have a 5,000 inflow, but you only have 2,500 that hasn't been recovered yet. So it'll take you, if those inflows are even, if you get 5,000 divided by 12, that's whatever that is a year, or a month rather, it takes you about 6 months in year 7 to get that 2,500 back, right? By the end of year 6, you have 2,500 to get that you haven't received yet, right? You've recovered everything except 2,500 by the end of year 6. So the first 2,500 you get in year 7 would reduce this to 0. But you're getting 5,000 in year 7, so that would take you maybe 6 months. 2,500 over 5,000, half a year, about 6 months. So about halfway through year 7, that's the payback. So about 6.5 years. It'll take you about 6.5 years to get your money back. After that, all these things are 0 because we don't count cash inflows after we received or recouped our investment. That's why those are zeros in the last 4 years. After we recoup our investment, we stop counting. So it takes about 6.5 years to get our money back, and then we just ignore any future inflows, which is one of the criticisms of the payback method. You know, if you have 2 different paybacks and you ignore any inflows after you receive or recoup all your investment, then one investment could be more profitable, but you wouldn't know that using the payback method because you stop paying attention to the inflows after you recovered 100% of your investment. And for part 2, would the payback period be affected if the cash inflow in the last year were several times as large? Well, the cash flow in year 10 is $2,000 according to this exercise, right? Cash flow in year 10, 2,000. What if the cash flow in year 10 were 20,000? Would that make a difference as to the payback period? No, it would still be 6.5 years. So that's what they're asking basically. Cash inflow in year 10 is 2,000. If it were 20,000 instead, the payback would still be 6.5 years. So it would not make a difference if you're just trying to answer the question, what's the payback period? It would still be about 6.5 years. Exercise 2. Again, net present value method. The management of Cocoa Company is considering the purchase of a $27,000 machine that would reduce operating costs by $7,000 per year. So we have an outflow on day 1 of $27,000. We have negative outflows, which we can count as inflows, $7,000 a year each year. And because it's more than 1, we would use table 2 for that. At the end of the machine's 5-year useful life, it will have a 0 scrap value, so we're not going to get anything back. Present value of 0 is 0. The company's required rate of return is 12%. So determine the net present value of the investment. Well, it's a $27,000 outflow now, and we have a series of 5 inflows of $7,000 per year. And there's something blocking the screen after column 5, but you have these in your hard drive already probably, right? Then the discount factor, 12%, because notice what they're doing here. What table are they using? They're using table 1 here, right? Because these 0.893, 0.797, those are all table 1 numbers. We could do that, but we don't have to. We could use table 2, because if we just add those 0.893, 0.797, 0.712, and so forth, if we add those together, that would give us the table 2 number. So the authors here decided to use table 1, but they could have used table 2. And then the present value is just 7,000 times 0.893, 7,000 times 0.797, and so forth. So the net present value is negative 1765. So should we invest in the new machine if the net present value is less than 0? You know, what's the rate of return they wanted? 12%. It means we're making less than 12%. If the net present value were exactly 0, we'd be making exactly 12%. Here, the net present value is a negative number, 1765. So if we absolutely need at least a 12% rate of return, we would not invest in this machine because it's a negative number. Or we could decide to maybe take 11 or 11 and a half, whatever that would be. So for requirement 1, determine the net present value. It's a negative 1765. For part 2, what's the difference between the total undiscounted cash flows and the cash outflows over the entire life of the machine? Well, it shows it here. $7,000 a year for 5 years is $35,000. The initial investment, $27,000. So you're $8,000 ahead in terms of cash flow. So you're making money, you're just not making 12%. You're making something less than that. And if you wanted to find out how much less, if you had a fancy highfalutin calculator, you could punch the right buttons. Or you could do trial and error. You know it's not 12%, so try 11. Just keep trying until that 1765 becomes 0. And that'll give you your rate of return. Or you could play around with the tables and do it that way too, like we did with some of the other things. Any questions about number 2?
So we could have just taken the 27,000 times, or sorry, the 7,000 times 3.605.
Yeah.
And then that would have given us exactly 1765 less than 27,000.
Yeah, we could take the 7,000 times whatever's in table 2, that annuity figure. We get the same number, get the same result. Yeah. For some reason, the authors decided to use table 1 instead of table 2. Probably just to show you that it doesn't really matter what table you use. The table 2 numbers came right out of table 1 anyway. This is just a way to show what the net inflow is for each year rather than just totaling them and having one at the end. You have one at the end of each of 5 years. Okay, number 3. This one's on the internal rate of return. Wendell's Donut Shop is investigating the purchase of a new $18,600 donut making machine. The new machine would permit the company to reduce the amount of part-time help needed at a cost savings of $3,800 a year. So that's like a negative outflow. That'd be the same as a cash inflow. So what's the present value of receiving $3,800 a year? That would be an annuity table, table 2. In addition, the new machine would allow the company to produce one new style of donut, resulting in the sale of 1,000 dozen more donuts each year. The company realizes a contribution margin of $1.20 per dozen. So $1.20 times 1,000, that would be additional income. So what's the present value of receiving that extra income? That would be a present value table. And because it's over more than 1 year, it would be table 2. The new machine would have a 6-year useful life. So n equals 6 if you like equations. Number of years is 6. So the first requirement, what would be the total annual cash inflows associated with the new machine for capital budgeting purposes? Well, total cash inflows also means negative outflows. So whatever money they can save, it says they save $3,800 a year. That's a negative outflow. You can treat that just like an inflow. So you take the present value of that. So the annual savings in part-time help, $3,800, and then you add the contribution margin for the expanded sales, 1,000 dozen times $1.20 each, $1,200. So the annual cash inflows are $5,000. That's for part 1. For part 2, find the internal rate of return promised by the new machine to the nearest whole percent. So the investment they're thinking about is $18,600, and their annual cash inflows are $5,000. So you divide that and you get 3.720. And this is over a period of 6 years. So you go to which table? Table 1 or table 2? Yeah, table 2. You notice the numbers on table 2 are all greater than 1. The numbers on table 1 are 1 or less. So you know it's going to be table 2, but this is a series of periodic payments, so you know it would be table 2 anyway. It's like an annuity. And so the number of years is 6. So you go to line 6, just keep going to the right until you find something that looks like about 3.72. That's sort of close to 16%. It doesn't hit the nail on the head, but
Oh, yeah, I guess it's supposed to be 16.
you know, the number that comes closest, again, you go to table 2, the annuity table, and it's 6 years, so you go to line 6, and you keep going to the right, to the right, to the right, until you come to a number that looks close to 3.720. The number that comes closest to that is in the 16% column. It's not exactly 3.72, but it's the closest. Questions on that one?
Closest to 60%.
Yeah.
So you always use the closest one, right?
Yeah, always use the closest one. In some books, you have to calculate more precisely. You know, if it's between two numbers, you figure what's the distance between one and the other, 30% or 70% or whatever. This book doesn't go into that, so, and that's probably fine with you, right? We're covering a lot of territory here. So, part 3, in addition to the data given previously, assume that the machine will have a $9,125 salvage value at the end of 6 years. So in that case, we have to figure what's the present value of receiving $9,125 in 6 years. Which table would we use for that? 1 or 2? 1, because it's a one-shot deal. We only receive it once. Under these conditions, compute the internal rate of return to the nearest whole percent. And they give you a hint. You may find it helpful to use the net present value approach. Find the discount rate that will cause the net present value to be closest to 0. So let's say the cash flows will not be even over the 6 years of the machine because they're getting an extra $9,125 at the end. Therefore, the above approach cannot be used to compute the internal rate of return. Use a trial and error or some other method. The internal rate is 22%. And how did they get that? You just keep playing with the numbers until present value is 0 or very close to 0. If you try 25 and it's not 0, then you try 18 maybe, and that's not 0. Trial and error until you get to 22%, where the net present value is 0. Or if you have a fancy highfalutin calculator that you push the right buttons, you get that 22%. That one could take a few minutes to do. I don't know if the quiz asks the question like that. Does it? Anyone take the Chapter 8 quizzes yet? No. It's usually best to wait until after the presentation.
So you could ask a question like that, that's the quickest answer, quickest way to get the answer.
Well, if you have a fancy calculator, it's easy. But yeah, if you don't, it's trial and error. You just plug in a percent and see if it's 0. If it isn't, try another one. If you're getting farther away from 0, take a percent that's in the other direction. Trial and error. I hope they don't give you one of those on the quiz, because that involves some guesswork too. I mean, eventually you'll get it, but if you guess close, it won't take you as long. You know, time is a factor. Number 4, uncertain future cash flows. Lukow Products is investigating the purchase of a piece of automated equipment that will save $400,000 each year in direct labor and inventory carrying costs. So that's a negative outflow. Again, that's the same as a cash inflow. It's $400,000 you don't have to pay somebody. This equipment costs $2,500,000 and is expected to have a 15-year useful life with no salvage value. The company's required rate of return is 20% on all equipment purchases. Management anticipates that this equipment will provide intangible benefits such as greater flexibility and higher quality output that will result in additional future cash inflows. That's another thing. If you make higher quality stuff, you won't have as many rejects. You'll have a lower reject rate. Customers will like your stuff, and maybe you'll gain more customers, more repeat sales. That's sort of intangible, though. You can try to put a number on it, but it's sort of intangible. So the requirement at the top of page 361, what dollar value per year would these intangible benefits have to make the equipment an acceptable investment? We ran into this on the slides before, yes? Something very similar. It's a somewhat different fact situation, but not a lot different. The equipment's net present value without considering the intangible benefits. You have that $2.5 million outflow on day one, so we don't have to discount that. It's just negative $2.5 million times 1.000. And the annual cost savings for 15 years, $400,000 a year. And at a 20% discount rate, you go to table 2. Why table 2? Why not table 1? Because it's a series of years. Yeah, it's a series. It's more than one, right? It's 20 years, so we use table 2. And if it's a 20% discount rate for, how many years was it? 15 years. So 15 years, 20% discount, we get 4.675 from table 2. That's where that comes from, 4.675. We multiply that by the annual cost savings, which is like an inflow, 400,000. So when we add all that together, we get a negative 630,000. The net present value is a negative 630,000. So if they ask us, should we get the equipment, the answer would be no. But that's not what they ask us, right? What they ask us is, what dollar value per year would these intangible benefits have to make the equipment an acceptable investment? And the intangible assets might be higher quality product, lower defect rate, things like that. If it's a lower defect rate, we can put a number on it. But if it's just higher quality product with the same defect rate, we can't really put a number on it, but we're doing that here anyway. It's just, we have to ask ourselves, is that acceptable?
So that 134,759 per year until it equals 630?
Yeah, if the intangible benefits are at least 134,759, then we would get the machine.
But it says per year.
Yeah, per year.
But, I mean, are we gonna have the machine for 15 years? If we have that value for 15 years, it's gonna be a lot more than 630.
Well, let's see, the annual value of intangible benefits, grade math, 6,800. Yeah, well, if we discount this, again, it's a heavy discount, 20%.
Oh, you mean, it would be 134 and then the next value would be discounted and the next value would be discounted?
Yeah, but, well, I mean, 134,759 5 years from now wouldn't be the same as 134 today, right? I mean, it's already figured into the equation. For those in cyberspace, we're talking about, is the 134,759 an annual figure? The answer is yes. Because it's heavily discounted, 20%, like 5 years from now, the 134,759 would be some other number. But we don't have to do that because it's already included in that discount factor, the 4.675. Yeah. So we have to ask ourselves the question, are we getting 134,759 in terms of intangible benefits? You know, is it worth it by having a higher quality product that may result in more sales, more repeat business because people like our stuff better, it's higher quality than that of the competition, maybe we can increase sales. Plus there's a certain pride involved in making good stuff. Those are all intangible benefits. Is it worth that amount? That's a highly subjective question. So we can come up with a number, but then we have to say yes or no. Questions? No? Okay. Number 5, preference ranking. Yeah, if you have a choice of projects, but you don't have enough money to invest in all of them, what do you do first? What do you not do at all? Number 5, information on 4 investment proposals is given below. So we have A, B, C, and D. The investment required, either 90, 100,000, 70,000, 120. Present value of cash inflows, They're all positive, 126, 138, and so forth. So the net present value is whatever's left, 36, 38, 35, or 40. Well, obviously, we would invest in project D first because 40,000 is more than those other three numbers, right? All right. It's all in how I asked the question, right? So you know it's not D just because of the way I asked the question. But do you know why it's not D? Well, that's what the number crunching is all about. I mean, the reason the author gave us this one is to show us that just because something has the highest net present value, for project D, it's 40,000. That's more than the other three projects. But that's not the one we should rank first. Because, you know, what if in order to get that 40,000, we have to invest $20 million or something? That's not a good rate of return. So we have to take the size of the investment into account. And also the life of the project has something to do with it, 5, 6, 7 years, whatever. So the first requirement, what question, comment? No? Okay, the first requirement, compute the project profitability index for each investment proposal. So we have the numbers there, the present value and the investment required. For project A, 36,000 divided by 90,000 is 0.4. And for B, C, and D, it's something else, 0.38, 0.50, 0.33. So we take the highest number first. 0.5 is the highest number, so project C would be our first choice. And the next highest number is 0.4, that's project A. The third highest number is 0.38, that's project B. And D is only 0.33. So as it turns out, even though project D has the highest net present value, 40,000 in terms of dollars, it's the least desirable of those four projects because it's the least profitable when you compare it to the amount of investment you have to make.
So that just really says that it costs more to make money on that scenario?
Yeah,
And
you have a
costs
lower,
less in scenario C.
yeah, you have a lower rate of return. Yes? So, okay, so part two, they ask us to do the ranking, and that's all they ask for, basically. Now, what about the fact that the life of the project is different? 5 years, 7 years, 6 years, 6 years? Shouldn't we take that into account? Are we comparing apples and oranges here because the project terms are different? Notice for project A, it's a 5-year project. Project B is 7 years and so forth. Should we take that into account? Have we missed something here? Should there be a part 3? Well, you'll notice that the present value of the cash inflows is already given. So the present value takes into account the fact that the projects are of a different length. I thought I'd mention that just in the interest of completeness. You know, the fact that the projects are 5 or 6 or 7 years or something, they're different number of years, is irrelevant for purposes of this particular exercise because it's already taken into account. They give us a present value that takes that 5 or 6 or 7 years into account. And it's also a good way to make these calculations because then you're comparing apples to apples instead of apples to oranges, you know. I mean, what's the present value today for project A, B, and C, and D? It doesn't matter how long it is, different lengths, but it doesn't matter because the present value today will compare the value today for 4 different projects. So the fact that the life of the project is 5, 6, or 7 years, depending, we can totally ignore that because it's already built into that present value number that they gave us. Number 6. Simple rate of return method. The management of Ballard Microbrew is considering the purchase of an automated bottling machine for $120,000. So that would be an outflow on day 1. The machine would replace an old piece of equipment that cost $30,000 per year to operate. The new machine would cost $12,000 per year to operate. So instead of having a $30,000 outflow, they'd have a $12,000. Isn't that the same as having an $18,000 inflow? Instead of 30,000 outflow, it's a $12,000 outflow. It's sort of like an $18,000 inflow, isn't it? Yeah. The old machine currently in use could be sold for a scrap value of 40,000. So if they decide to get the new machine, they're going to have a 40,000 inflow. If they decide not to get the new machine, they won't have the 40,000 inflow. The new machine would have a useful life of 10 years with no salvage value. So the requirement is to compute the simple rate of return on the new automated bottling machine. So the hardest part is figuring out where to start probably, right? Unless you do enough of these and then you say, oh, I know exactly where to start. But the first few times you do this, that's the initial hurdle, right? So where do I start? So let's see how they structured this. The operating cost of the old machine was 30,000. The operating cost of the new machine is 12,000. So less the annual depreciation. It's a 10-year machine, so 120,000 divided by 10. You're getting 12,000 in depreciation each year. So the incremental net operating income is 6,000. We haven't really taken depreciation into account before, though, have we? No. Why are we taking depreciation into account now? Because depreciation has nothing to do with cash flow, right? If depreciation were 12,000, would you deduct 12,000 from cash flow? No, you wouldn't. You would deduct it, though, for operating income because that's an accrual basis figure. You can take non-cash deductions if you're on the accrual basis, but not if you're on the cash basis. But the equation or the formula requires us to use operating income. Notice the formula here, annual incremental net operating income. Net operating income is an accrual basis concept that follows generally accepted accounting principles. So we're not using the cash method here, we're using the accrual method, which is the only method you can use for financial statements. So we have to subtract depreciation because net operating income is an accrual basis number. That's why we subtract depreciation. I thought I'd answer that before you asked. Because you were all going to ask that question, right? Or maybe not. One person might ask. Because in a class of 30 people, one person would ask. But in a class with 1, 2, 3, 4, 7 people, maybe not. So anyway, this is the formula for a simple rate of return, the annual incremental net operating income. So we need the operating income, 6,000. And the initial investment was 80,000. Now, notice how we arrived at that 80,000. The new machine actually cost 120,000, but we're getting a $40,000 inflow by selling the old machine, the scrap value. So the actual investment is 80,000. So 7.5% return is a simple rate of return, 7.5%. Number 7. Ugh. This could take more than a few minutes. I noticed it's now like 8:28. It's almost time for our break. And the fact that she just left indicates that she's had enough anyway. Yeah, it's going to take a while to get through this one. So maybe this would be a good stopping point. Yeah, you do have the answers to all these. So, and you know, if there's something you don't know or something you asked either in class or by email, I'd be glad to answer it. Maybe not right away because I have to sleep a few hours a day. But, okay, well, thank you for coming. Thank you for tuning in out there in cyberspace. Again, one of my favorite chapters. It's tough to say which is the favorite though, because there are a few really good ones, which this is one. Anything that has present value is pretty good.
Talk to you later.
Okay, thanks for coming.